Hello, this is Jonathan Thomas, and I'm joined with Joe Zappia, and it is November 1st, 2022. This is the fourth quarter state of the markets. First things first, disclosures. This is not meant to be financial advice. So this is purely entertainment purposes only.
Yeah, thanks, Jonathan. Hello, everyone. So let's just do a little review of asset classes through the third quarter of 2022, which of course is this year, September 30th. Year to date, pretty much every asset class is negative with the exception of commodities. US large cap stocks are down almost 24%. And it looks that way around the rest of the world as well. International developed stocks down 27, emerging markets down 27. We'll talk more about this later, but bonds are down in the United States about 15% year to date, and this is the worst bond market ever. We'll provide a little more details later, but in general, we've had a complete risk-off trade this year where pretty much everything is down. I think maybe one of the more interesting points from this entire chart, however, is that U.S. large cap stocks 10-year average return is still 11.7% per year. And if you follow what the average returns are for these sorts of stocks, the 100-year average, what is it, Jonathan, around 10%-ish, 9 to 10% a year. So on a 10-year basis, even with this year's big decline, U.S. Stocks are still ahead of their long-term averages.
Yeah, absolutely. So yeah, pretty much nothing has worked this year, especially not the last quarter. So October, of course, was a great month for especially U.S. stocks. The Dow was up over 10%. The S&P was pretty close. So it was good October, but certainly finishing the third quarter wasn't so good. And really, the story all year since the beginning of the year has been inflation. So for the last 5 or 10 years, call it, the Fed has tried to get inflation up to 2%. They were trying to cause inflation to get it up to 2%, and now it's just spiked, call it 8, 9, almost as high as 10%. So, but really the story is, and what we're looking at is that a lot of these numbers are really rolling over. So yes, they have spiked, but things like, which we'll show on this next slide, Purchasing Manufacturers Index. These are like forward-looking indicators of what CPI or what the actual inflation rate is going to be. That's rolling over. Home prices, everyone sees price cuts possibly in their neighborhood of houses that were for sale 6 months ago, 3 months ago. You're seeing a lot of price cuts, people backing out because interest rates have spiked. Rent prices are falling off a cliff. Used car prices falling off a cliff. So there's a lot of things that are going on behind the scenes that I think are going to be shown in some of these inflation numbers going forward. So we think really the worst is behind us. Doesn't mean that we're going to go back to 2%, but it's likely that those super high numbers are going to come back down to earth a little bit.
Yeah, so absolutely. So let me just add a couple points to that. I think that in the media and in the headlines, there's a lot of time and energy spent around the CPI, the Consumer Price Index. It's probably the single most important economic number, at least to the news media, on a monthly basis because it measures inflation. But the problem with the measurement is it's very backward looking. And what Jonathan was just talking about here was he was showing you some leading indicators that are pointing to the fact that we believe, and inflation is impossible to predict, but we believe that based on some of these indicators, we're going to start to see inflation just sort of naturally come down. Probably will be more sticky. That's unknowable. But that's what the intention of showing you some of those leading indicators is. It's our job to think forward, not look backward.
Mm-hmm. Absolutely. And really all the Fed can do at this point with inflation to try to tame it is to raise the federal funds rate. And so going back throughout history, you can see prior Fed hiking cycles. This has been the fastest hiking cycle ever in history. So we went from about 0% on federal funds rate to about 3%. And that's a huge move in such a short period of time. Historically, when the Fed has done that, it's taken years to play out. They've had a lot of time on their side. Maybe inflation didn't spike quite as much as it had. So they had that time, but now it's a little bit of a different story. And that explains why the bond market is doing what it's doing, because we went from literally earning 0% interest to about 3 or 4% seemingly overnight. And because of that, bonds really sold off. Well, let's talk about stocks for a moment, Joe.
Yeah, absolutely. So continuing on that same theme, one of the objectives of central banks in raising interest rates is to bring asset prices down. So follow the Fed is just a very strong investment mantra that works extremely well. When the Fed is cutting rates, generally asset prices move higher. That would include stocks and real estate. And when the Fed is increasing interest rates, assets tend to come down. And then, again, this is the Fed's intention. So they're raising rates to cool off the economy. And the economy is represented by the stock market. And we've had a dramatic decline in the stock market. Through the end of September, the S&P 500 was down about 25% year to date. And what this has done, we show this chart almost every quarter. What this has done now at the end of the chart, you can see September 30th, the forward PE multiple on the S&P 500 was somewhere around 15 times, which is not too far from the historical averages, which we'll show you on the next page. So markets went from being extremely expensive, and we talked about this, Jonathan, in our fourth quarter 2021 video about this time last year. And we also talked about it again in our first quarter video of this year. The stocks were in the 90th plus percentile of expensive relative to their history. You can see that on the chart. This line represents the change in the PE multiple of the S&P 500 going back to 1997. And you can see that, not to get too technical, but this line was way, way, way above one standard deviation at the end of 2020 and most of 2021. And since the Fed began raising rates pretty dramatically, you've seen the stock market drop a lot. But at the same time, earnings have actually grown by a little bit. So the stock market has gotten significantly cheaper. And I think, just to sum it up, is the title of the slide. The bear market is doing its job. It's bringing stock prices down to more reasonable valuations. So what's super interesting to me about all of this is that what's going on this year in the stock market isn't that crazy. We have a bear market about once every 4.5 years in modern times, and the average decline is somewhere in the neighborhood of 25 to 30%. And we almost always have a correction greater than 10%. I think we average one intra-year decline of about 14% a year going back to 1980. That's what this chart shows you. All the way to the right, you can see year to date in red, the S&P 500 is down 25%, but there's been plenty of years we've had these kind of declines. So while it's unsettling, and I guess not that surprising, at least from our standpoint, again, we talked about it a lot before it happened, stocks have come down to the point where they're a little closer to fair value and a lot less expensive. But this year's decline isn't the worst bear market in history or any of those sorts of things. However, we think the bigger story is with bonds.
Yep.
And it's interesting because everybody talks about stocks. I guess it's just as popular in the media, but bonds are absolutely getting destroyed. And this chart goes back to 1996. This is 46 years of history. The decline this year is 15%. It is the biggest drawdown of at any point on this chart. There's only been, I think, 3 or 4 negative years in bonds in the past 46 years. This year, the magnitude of the decline is like 5 times greater than the biggest decline really in any prior year. And if you go back farther in history, this is the worst year for bonds since they've been keeping track of bonds, which is somewhere around the Civil War times. And one of the things Jonathan has been saying to clients in meetings that I think is so important is how much diversification and risk management used in portfolios this year with using bonds and stocks together, whether it's 100% bonds or 100% stocks or 50-50, your portfolio is down somewhere between 15 and 25% year to date if you had a traditional portfolio that uses like a bond index and a stock index. So there really has been nowhere for investors to hide this year if they've been fully invested in a diversified portfolio.
Yeah. And then if you see these charts and you say, oh, wow, looks like a great opportunity, a great time to buy. Well, what do you sell to buy to take advantage, right? Like, do you sell stocks to take advantage of the drop in bonds or vice versa? So really, it's hard to be extremely positive or really make a move and take advantage of these prices because most people are somewhat fully invested, right?
Yeah, and we use we use pretty sophisticated trading software to help us understand where portfolios are underweight and overweight. And almost every time, at least in my career, that the stock market has dropped by 20 or more percent, bonds are positive by a fair amount. And that leaves rebalancing opportunities because you have bonds that are up in value that you can sell some of to add to stocks while they're down. And I think that's the real point here is it's very difficult to rebalance this year because everything's down if you're a fully invested client.
Yeah, absolutely. All right, so the next two charts we really like. This looks at S&P 500 declines of 25% or more going back to 1950. So there have been 2, 4, 6, 8. This is the 9th time that this has happened. And the returns going out if you were to purchase the day after the S&P fell 25%. And so for us in this case, the S&P fell 25% at the end of September. So that would be like buying October 1st. Well, if you did that, we already mentioned October was a really good month. So maybe we're on track for another one of these great 1 year, 3 year, 5 year, 10-year periods. So, now is a really good buying opportunity, potentially, if you have that long-term horizon. But this chart really plays off of the last one. And what I like to look at here is the ultimate bear market. So yeah, the S&P fell 25% in each one of these, but it didn't just fall 25%. And really the average drop ended up being about 40. So you never timed the bottom perfectly. And in a lot of cases, the days to the bottom was quite substantial. The average day to the bottom was 125 days. So really the median was just 37. So yeah, maybe we're not at the bottom, but we could be close, but who knows? We could be really far away. The idea here is that the returns a year later, 3, 5, 10 years out after buying when the market's off this much are usually really positive.
Yeah, I just want to add a couple comments to this because these charts really are, in my view, super, super important for a couple of reasons. The first would be that if you did buy when the market was down 25%, on average, you were about 125 days early. And on average, the market lost another 10 to 15% before ultimate bottom was made. And even given those, let's say bad timing decisions, 1 year later, on average, that dollar you invested was up close to 23%. So it's really impossible to time the bottom. And it is possible that things really do get worse before they get better, but it's also just as possible that they don't, so it's one of those things where this is sort of a known unknown. It's impossible to predict these sorts of things. But I think one of the key points that I want to make, and Jonathan, you and I have talked about this. So if you just want to go back to that prior slide for a second, I think one of the most important takeaways here is that with the market being down 25%, if the average return 1 year later is like 22 or 23, if an investor rode the market all the way down and they don't add to markets when they're down, even with that increase a year later, they're still not back to even. And in fact, on average, about 3 years out, they're just barely back to even because the arithmetic of loss is that if you have a 25% decline, you need about a 30% gain to get back to even. So the moral of the story is markets really do get better after they decline 25%. No question about it. The data is irrefutable. But the most important thing is, as an investor, to be adding to equities when they're down, regardless of how comfortable you are. So what the way I've been thinking about is one of the best ways to be defensive right now is to go on offense and actually add to equities where they're down. And what that will do is that will give you a better total return 1, 3, 5, and 10 years later.
Mm-hmm. Yep, completely agree. And so I guess what we're also trying to say is that the market is forward looking, and there's a lot of talk of could there be a recession? Are we in a recession, et cetera? But the market still, at the end of the day, it fell over 25%. So maybe we've already priced in a lot of that bad news. And so if you're waiting for the news to get better, and this is what a lot of people do, right? We saw this with COVID around the vaccine. People were waiting until there was a viable vaccine that people can use so that COVID would eventually end. If you waited until the vaccine announcement, you were far too late. If you waited for hospitalizations and cases to come down, you were far too late. So if you're waiting for the news to get better, I think this is a really telling slide. These are headlines at the bottom. This was March 9th, 2009, the day the market bottomed during the Great Recession. These are headlines in the Wall Street Journal. And I can't find one single piece of positive news, something a little bit uplifting or encouraging, saying, you know what, maybe this is the bottom. Like there are no bells ringing here. This is not good. So this is about as bad as it gets. And this is when markets sometimes truly bottom. So waiting for good news and the news to get better, or maybe you're waiting until after the midterms, it's probably not the best idea.
Totally. In fact, I would argue that the price of the market is an indicator of what the market thinks about the future, and it's almost never the opposite. And what I mean by that, as Jonathan said, is markets are so forward-looking. So um, I think to sum up our commentary around the stock market and bear markets and typical, recoveries and those sorts of things is that we're not in any way saying that the bottom's been made. We're not, because it's impossible to know a bottom is made until it's been made. And we're not saying that things necessarily have to get worse. I think, again, it's unknowable. And the headlines today, it's awfully hard to find any kind of good news in the headlines, as Jonathan mentioned. But who's to say the headlines can't get worse before they get better? The important thing is just know that the odds are in your favor to buy or add to your stock positions when they're down 25%. So let's just segue a little bit to some other opportunities that we're seeing. And this is, once again, where the news is really bad, and that's outside the United States. European stocks, particularly the closer you get to Ukraine, but Western Europe, these stocks and markets are priced for almost complete and total calamity. The markets are trading at places that they haven't traded at in decades. So the chart on the left just shows the average PE of international stocks, and you can see it's 2 full standard deviations below any place it's ever been. And in many ways, if you go back even beyond 2002, you're talking about going all the way back to World War II to see the same kind of low valuations in international stocks. And then the chart on the right, we think this is important because, as you know, we're dividend focused investors in equities and international equities right now. The dividend yield on the international index outside the United States is the highest yield on average, which is almost 2% going all the way back to 2002. So again, dividend yield is also a function of prices being down. So one of the things you're likely to see us be doing in portfolios is slowly increasing our international allocation as we think that the news will start to get better coming out of Europe in the coming months.
Absolutely. So what do we got here, Joe? This is stocks can go nowhere for a long time.
Yeah, I have this chart in here as just sort of a reality check for everybody. So from 2001 to 2009, the S&P 500 went from nowhere to nowhere. In fact, it had a negative return. Everybody called it the lost decade. There were places, though, to make money during the last decade, but nobody really talks about this period in time. And this is from 1965 to 1985. But I really want to take a point from 65 to 82, and that's where the S&P 500 went from 100 to 100. By the way, what's so interesting about this is, where's the S&P 500 now? 3,900?
A lot more, yeah.
Yeah, so, again, we'll talk about a period in time where markets didn't move, but there's also a lesson here that the S&P went from 102 in 1982 to 3,900 in 2022. So, growth does happen over time. But during this environment, you had lots of rallies, you had lots of sell-offs, you had 2 or 3 big bear markets. But it wasn't really until inflation meaningfully moved to under 5% that the stock market was actually able to regain its footing. So we might be in an environment where that's the case, right? We might be in an environment where inflation runs higher than people think, certainly not 8, but maybe 3 or 4%. Interest rates are more normal. And that leads to an environment where stocks probably return a little bit less than they have over the last 10 years. And there's ways to invest around that. And we believe that we have our portfolios largely positioned for an environment that's a little more difficult going forward than it has been, let's say, over the prior 10 years. So this chart's just there just to remind people that stocks can go nowhere for a long time. So let's sort of sum it up with some bullet points and some thoughts. We added this chart or this page to our most recent quarterly video, and we got really positive feedback from everybody. So thank you. So we thought we would keep it in here. So as I said, we think we should expect higher inflation and higher volatility for a while, and that'll be disconcerting, certainly for investors. But It's one reason why you've hired professional advisors to guide you through that. Know that recessions and stock prices are absolutely not connected at the hip, as Jonathan showed you. Stocks will bottom way before a recession becomes evident, and nobody's good enough to know when will take place. Take advantage of the fat pitch right now. The Federal Reserve is providing us with really high short-term interest rates. In our client portfolios, we're putting putting cash in money markets that are yielding over 3%. We're taking advantage of short-term treasury bills that are yielding 4 to 4.5%, short-term corporate bonds that are yielding 5.5%. Take advantage of these sorts of things to get the safe part of your portfolio finally earning some interest. Remember, dollar cost averaging always works. We provided lots of evidence earlier in the presentation about why to buy when stocks are down 25%. Continually adding to stocks when they're down will increase your long-term returns over time. And last thing we're doing in portfolios that I think is a little bit harder for individuals to do is we're actively tax loss harvesting in portfolios. And that simply means capturing capital losses in portfolios today, keeping your exposure in your portfolio. And this gives you more money in your pocket by reducing your tax bill come April 15th or whenever you file your taxes.
All right, great. Well, that's it. Thank you all for making it this far with us. We appreciate the feedback and the comments we've gotten. Feel free to share with anyone who may find this of interest, and we look forward to seeing you next time.
Thanks, Jonathan. Thanks, everyone.